Welcome to IQD Dinar News, your go-to source for the latest updates on currency exchange rates, revaluation news, and insights into the Iraqi Dinar. Stay informed and ahead of the curve with our timely analysis and breaking developments. The statement discusses a significant shift in monetary policy by the central bank, particularly as articulated by an advisor to Prime Minister al-Sudani. This shift is characterized by a hybrid approach that reflects both an expansionary monetary policy and a continued focus on liquidity control through sterilization operations. Starting with the specific actions taken by the central bank, on October 24, it decided to reduce its monetary policy interest rate significantly, lowering it from 7.5% to 5.5%. This reduction of approximately 200 basis points indicates a major strategic move towards making borrowing less expensive for commercial banks. By decreasing the interest rate at which the central bank lends to these banks, the intention is to encourage banks to lend more to businesses and consumers. This approach is grounded in the theory that lower interest rates typically lead to increased borrowing, which in turn can stimulate economic growth. The phrase expansionary policy in targeting the money supply signifies that the central bank aims to increase the overall money supply in the economy. In essence, by lowering interest rates, the central bank is promoting greater access to capital. This is particularly important in times of economic uncertainty or recession, where businesses may be hesitant to borrow due to high costs of capital. By making borrowing cheaper, the central bank hopes to bolster spending and investment, which can lead to job creation and economic expansion. However, the advisor also emphasizes that this new monetary policy does not ignore the necessity of maintaining control over local liquidity levels. Liquidity in this context refers to the availability of liquid assets in the economy. High liquidity can lead to inflationary pressures if too much money chases too few goods. Hence, while the central bank is looking to expand the money supply, it must simultaneously implement measures to avoid excessive liquidity that could destabilize the economy. This dual focus on expansionary policy and liquidity control is achieved through what is referred to as high sterilization operations. Sterilization in monetary policy refers to actions taken to counteract the impact of foreign exchange interventions on the domestic money supply. In this instance, the central bank is likely looking to offset the increase in money supply from its lower interest rate policy by selling financial instruments to absorb excess liquidity. To implement this strategy, the central bank is offering debt instruments called Islamic certificates of deposit. These instruments represent a type of sovereign debt that the government issues, and they are compliant with Islamic financial principles, which prohibit interest. These certificates can be viewed as a way for the government to borrow money from the market while providing investors with a secure and Sharia-compliant investment opportunity. The inclusion of these instruments is significant as it reflects an effort to diversify the financial products available in the market and to cater to the preferences of investors who adhere to Islamic law. The advisor notes that these certificates are considered excellent debts, which suggests they carry a low risk of default and are likely seen as a reliable investment. The rates of return on these certificates are also outlined, a return of 4% for a period of 14 days and 5.5% for a period of 182 days. The short-term and medium-term maturities offer investors flexibility while allowing the central bank to manage liquidity over different time horizons. By offering these debt instruments, the central bank is not only providing a means to manage liquidity but also creating avenues for investment in the local economy. This approach can help attract both local and foreign investors, thereby increasing capital inflows, which can further support economic growth. Furthermore, the implementation of this hybrid monetary policy indicates an awareness of the complexities involved in managing a modern economy. The central bank is recognizing that simplistic approaches to monetary policy may not yield the desired outcomes in an increasingly interconnected and dynamic global environment. By employing a hybrid strategy, it acknowledges the need to adapt to changing economic conditions and to consider the broader implications of its policies on financial stability and economic growth. Overall, the recent changes to the monetary policy by the central bank, as articulated by al-Sudani's advisor, represent a significant shift towards an expansionary approach while maintaining a careful balance with liquidity control through innovative financial instruments. This dual strategy could potentially stimulate economic activity and investment while mitigating risks associated with excess liquidity. As the situation evolves, the effectiveness of this hybrid approach will likely be scrutinized by economists, financial analysts, and policymakers alike, as they assess its impact on the economy's trajectory and the overall financial landscape. In conclusion, the measures being undertaken by the central bank reflect a nuanced understanding of monetary policy that aims to balance growth and stability in a challenging economic environment. By employing tools like interest rate adjustments and Islamic financial instruments, the central bank is positioning itself to effectively respond to both domestic and international economic challenges while fostering a more robust financial system. As these changes take effect, they will undoubtedly influence the economic landscape, shaping the prospects for businesses, consumers, and investors in the region. Thanks for tuning in to IQD Dinar News. Don't forget to like, share, and subscribe. For more updates on the Iraqi dinar and global currency trends, hit the notification bell so you never miss an update. See you in the next video.